Since the start of 2023, stocks have been rallying in the face of really bad news. And although it does look like inflation has peaked, it's not going anywhere. That being said, a lot of bearish analysts are actually conceding to the possibility that there might be a soft landing or even no landing at all when it comes to the economy. So now that it looks like stocks are never going to go down, am I going to become bullish? No, I'm still bearish. And let's get into reasons why with this episode of Get Irked Stock Market Outlook. Over the course of the past week, we saw reports from CPI, PPI, and a whole bunch of other acronym reports that show that inflation is not coming down as fast as the Fed is expecting. In fact, in some interviews, Fed presidents said that not only are we going to have to keep raising rates and keeping them there for longer, a few of them even suggested that we do another half-point rate hike instead of quarter-point rate hikes, and all of this is pretty bearish. But you'll still hear all of the bullish pundits say that the job market is strong and therefore the economy is strong. But I did a little research, and here's something funny I found out. Before every big recession, there is a lot of talk that the Fed has engineered a soft landing. This is not new. This happens before every recession. Even worse, going into recessions, often the job market is strong and remains strong 3 months into the recession before everything falls apart. And does that mean we're going to have a really bad recession? Well, not necessarily. And like I always say, my own personal perspective of whether or not I'm bullish or bearish doesn't affect the way that I invest for the long term. I always have a plan for what I'm going to do if stocks go up tomorrow and what I'm going to do if stocks go down tomorrow. Last week, I mentioned an analyst named Michael Gaed who had actually predicted the melt-up that we've been seeing since the beginning of 2023. And this week, he said, finally, that it looks like risk-off is going to come and that it's going to happen in March. So stocks might continue rallying through the end of February. But when March comes, it's time to have a plan. If stocks continue rallying through the end of the month, I'll continue taking profits. But if stocks start to sell off, I'll start looking at places where I can add to my positions. When you look at this week's investments in play, you can see that the biggest winner this week was Twilio, which had a really outstanding earnings report and popped 17.69%. You can also see that Coinbase has once again regained its rally, gaining 14.51% on the back of Bitcoin, which broke $25,000 this week on the back of SEC news. This is the only sector that rallies because there's going to be more regulation in the space. And when it comes to cryptocurrency, the reason why they rally because of more regulation is that the institutions can't invest in the space until there is more regulation. This week's loser was Skyworks Solutions with a loss of 3.14%. And the only reason for this is that Skyworks has seen a really incredible rally from the beginning of 2023 and on the back of its good earnings reports. This is just a healthy pullback. When we look at the speculation in play, this week's winner was DraftKings with an epic 28.46% gain off of its earnings report. Not only did it beat on revenue and on guidance, it blew away any expectations analysts had, and that's why we saw such a huge pop in the stock. You'll notice that the speculative stock Virgin Galactic is once again on the move, rallying 27.66% this week on no news. Virgin Galactic has not reported earnings yet. And this just shows how risk-on the market still is. This week's loser is natural gas, which dropped another 11.28%, even though it looked like it might be recovering last week. Because of the unseasonably warm weather and the fact that Europe is able to get all of the natural gas it needs right now, natural gas is just plummeting in price, with no end in sight. As always, I like to use my investments in play to figure out what the market sentiment is, looking at how each of the positions make up the overall portfolio. You can see that the leaders haven't changed this week, with both Nvidia and Apple still making up the biggest positions in the portfolio. However, you can see that speculative investing is back, as the new spec basket has once again made it into the top 5. To me, this isn't a good sign of market health, because as you can see, the majority of the members of that basket are very new and very volatile stocks, including Coinbase, Roblox, Rivian, SoFi, and more. The fact that it's increased in size in a week where a lot of stocks had actually sold off just indicates to me that a lot of people are going full risk on, which means there's even more chance of a significant pullback when it comes. The first move I'm going to talk about this week is actually a member of the pandemic portfolio, Barrick Gold, with the ticker symbol GOLD. When the Fed started talking about raising interest rates even higher and keeping them there longer, precious metals like gold and silver sell off. And the reason for this is that people would be more likely to buy a treasury with a 5% yield than hold a non-yielding asset like precious metals or even Bitcoin. As a result, Barrick Gold has sold off pretty significantly, dropping a total of 17.5% from its recent high in January. You'll notice that gold bugs and Bitcoiners are very similar. They always tell you that this is going to be it and this asset is going to moon, and you can't listen to the bulls because they're always bullish. One of my favorite mottos is that you need to take profits when you have them, because otherwise the market will take them from you. And this is why I sold on January 13th at $19.71, even though the bulls said this was it, gold's going to rally to $3,000 an ounce. Because I took those profits, I was able to replace the shares that I sold on January 13th this week on the 17th of February at $16.48, effectively locking in a 16.39% discount on those shares. This sale also lowered my per share cost 1.05% from $19.10 to $18.90. And from here, my next buy target is down here at $14.52, which you can see has provided support in the past. My next sell target is up here at $20.12, and you can see this is where it was at its high in January. And even though the next time gold goes up, it may actually be the next bull rally, I still have to take profits on the way up. Next, we have DraftKings, which had a serious pop after reporting that blowout earnings report. And this made me want to take even more profits in it, as it is at a place that has seen resistance before. So I sold shares on February 17th at $21.16, even though this is under my cost basis. The reason for this is I do think DraftKings is going to see resistance there and pull back, so I want to free up capital in order to buy at lower levels. This sale raised my per share cost 4.85%. From $29.90 to $31.35. And from here, I'm going to wait to take any more profits until it exceeds my cost basis. So the next point of resistance above my cost basis is around $45. So my next sell target is $43.60. My next buy target is a point of consistent resistance that you see down here at $10.95, where over just the last couple of months, you can see that DraftKings has regularly pulled back that far. So I have no reason to believe it won't do that again. On Friday, the natural gas fund made a new all-time low, breaking through its previous low at $8 and not finding support until $7.60, which is why I say you can never trust a bottom. It's also a good example of why I always use limit orders. I actually had to buy slightly below its all-time low at $8 at $7.98, but because it gapped open lower than that, I got filled at $7.88. Because we have no idea how low UNG might go, I continue to build this position very slowly. So this ad only lowered my per share cost 0.57% down to $8.75 from $8.80. And from here, my next buy target is at $7.37, a price I calculated using the Fibonacci method, which gave us a low down here of about $7.44, but I think it could overshoot that on the downside. My next sell target is $10.58, and you can see even in the recent past that it's regularly found resistance around this level, and this is something we can track back over the years that UNG's been in existence. It is a consistent point of resistance for this stock. Next, we have Roblox, which popped over 26% in one day following its earnings report. Now, Roblox did beat on earnings, but what was more important was its billings. In other words, Roblox makes its money from selling its Robux currency to users of its platform. The billings make up the Robux that users have bought, and they're buying in big numbers, so that was huge for the stock. The day after earnings, it popped and hit my sell target at $45.33. And some viewers might think that's kind of odd that I would sell there, since it only lowered my per share cost 2 cents from $45.07 to $45.05. But the real reason I took those profits was because I had 54.55% in gains on shares that I bought a couple of months ago on December 15th at $29.33. By locking in those gains, I'm able to use that allocation that I sold to add to Roblox if it gets to lower levels. From here, my next sell target is $49.55, a past point of resistance that Roblox has seen many times over the last 2 years. And my next buy target is down here at $26.35, a point where you can see there was a lot of support over the past year. In fact, it was over the past few months that it got down here, and I believe it can get that low again. I wanted to let you know I've removed all username and password requirements from my website, geterg.com. Although I always gave all of my content away for free, I no longer require you to register for anything. So go over there and check it out. There's a lot of content, including my stock shopping list, which I update almost daily. I want to thank you for watching. If you liked the video, please hit like and subscribe. It really does help me out. And I'll see you in the next video.